Okay. So in the previous class, we spoke about secondary market, right? Auction market, Sensex, how Sensex will be calculated, what is the purpose of having this indexes, Sensex, Nifty 50, and why there is a difference in points like NSE points, BSE points. And we spoke about gray market, DAPA trading, and also we discussed about circuits as well, circuit breaks, when it all happened and what was the reasons. Everything we discussed, right? I hope you guys are all good with those concepts.
Yes,
Should
ma'am.
we proceed with the remaining topic?
Yes, sir.
Yeah. Thank you. Thanks for the confirmation. So, yeah, hi Lokesh. He's saying hi to everyone. Hi. So we'll talk about square of long position, short position. Even before we going to discuss about square of, let's understand what is meant by a long position, short position. Okay. We already spoke about bullish and bearish, right? Do you guys remember it?
Yes, ma'am.
What is the bullish and bearish? When you take when we call it as a bullish, price the market is a the price of the markets are increasing. Then we call it as a bullish or bearish.
Bullish.
Bullish.
If security market prices are going down, then what we call it as
Bearish,
Bearish.
sir.
bearish. Yeah, you guys are good with this, right? What is the bullish and bearish? Now we will understand what is a long position, what is short position. Long position is nothing but the meaning. I mean, the name itself is saying it's for the long. So commonly we call it as we are taking it for the long period. That means we are buying a stock or another security. It can be stock or security, whatever it is. The expectations that the price will rise over a period of time. That definitely the we are expecting that price will go up. That's why we are purchasing this stock. So it's the most common investment strategy. Every people will invest into the stock market. We will expect that price will go up, and then we can sell the security. That is the expectation we will enter into market. Most of the people will enter the market with this kind of expectations only, right? Is it correct or not?
Yes, ma'am.
Yeah, that is called long position. Let's assume I'm purchasing uh, my TCS shares. T shares says, let's say 1,000 shares I'm purchasing at rupees 540 rupees each share. Okay, 540 rupees. So I'm expecting that TCS shares will go up. The price will increase in the coming days, maybe in a 1 month or 2 months or 3 months, even it can be for 1 year also. I'm expect that definitely there will be increasing of prices. So if I have an intention, if I assume that if I expect that prices will go up of this purchasing securities shares, then that is called taking long position. Taking long position. And what is meant by short positions? Short position means going for short period. Normally, it's going for the selling of securities. You don't know correctly, like we always expect that prices will go down. What we will do normally if prices are going to down? So let's assume the same example. We bought 1,000 shares, rupees each, 540, and we are expecting that prices will go up to like a 560 or 580, like that we're expecting. But it started getting downfall. The security market prices are getting down like a 530, 520. Then what do you do? We have two choices. Like we can continue for the same. Again, we will expect that again in future maybe the price will go up. Then we can sell it. That is the one option. Again, that's we call it as long position. Because again, we are expecting that prices will go up. Whenever we expect expectations are to have higher prices in the future, that is called long position. Opposite to that, what we can do? We can wait until prices start rising up. Otherwise, we have another option. What is another option? We can sell the securities. Instead of incurring with a lot of losses, we can sell the security minimum loss, right? Now we have a 540. So we can sell it 530 rupees or 520 rupees sell because the securities the prices moving down, right? So we can sell that security. Getting the point?
Yes,
Yes, ma'am.
sir.
That kind of buying, I mean selling the security is called short position. So short position we will do whenever the market is bearish. We will expect that prices will go down. Then we'll always take the short position and we will sell the securities. Now we understood the difference between short position and long position.
Yes,
Hello?
sir.
Yes, ma'am.
Yes, Mahesh.
Yeah. And also we have a square off. Square off is also similar to the same thing. Suppose we took a long position. we are taking a short position. That is called square off. Suppose we are taking a short position. In opposite that, if you are going to take a long position, that is called square off. So square off is nothing but normally traders will do this as square off. Normally like a closing out of open position. Already I have an open position, I can close it out. See in the short selling, I mean short position. Already we discussed about short selling, right? What we can do in the short selling? Without owning our shares in our account, also we can sell the securities, right? It basically
Yes.
selling the securities that you are not available in your hand. That is called short selling. Short selling. Short position also same thing. We are not own. I mean, we are not having any shares. Still, we are selling it. But the expectation is prices will go down so that again I can purchase back the securities so that I can make a profit. That is the intention of short position and short selling, right? So in this short selling or short position, what people will do? Traders will borrow the securities to sell them at a current market price. But the expectation is again we will repurchase them later at a lower price so that we can return the same shares to the lender. The difference between the purchasing and selling will be the profit to the investors. That is called short position, right? In the case of Square, in order to take the same reaction, we will take opposite action. That means basically to closing out the open position, can be long position or short position. To realize the profit or loss, we will take opposite position. So normally this will be done by performing the opposing transaction. Normally it always offsets original position. That is called square off. Let me tell you one example. Suppose I am purchasing 100 shares at rupees 10. What would be my portfolio if I purchase 100 shares at rupees 10?
1,000 rupees.
1000 rupees will be my portfolio. Few days, after few days, the prices are increasing up to like a 12 per share, 12 rupees or 14 rupees like that. If I want to square off this long position, what can I do?
You can sell off.
We can
I can sell it, right?
what? Yes.
I can sell it to the current market price. What is the current market price? I said 12 rupees. So at 12 rupees, I can sell this security. That is called square off. So if I do this square off, how much profit I'll get?
If it is 12 rupees, 2 rupees your
2 rupees per
is
share.
profit.
So 200 rupees profit I'll get. Why I am selling this share at 12 rupees only? I can wait for 15 rupees or 20 rupees also, right? Why I am selling at 12 rupees only now itself?
It may go down or it may go up. We
The
don't know.
prices
Yes.
may
It
fluctuate.
is not consistent
Yeah, when I
increasing,
purchase,
sir.
I expected that price will increase.
But
So
it
I'm
is not
keeping
been done.
I'm keeping it. But at the 12 rupees price, I came to that prices are well going down. My expectation is that after 12 rupees, again prices will go down. So I don't want to incur with a lot of losses. So let's select for 12 rupees itself. Basically, I'm exiting that long position. Initially, I purchased all these shares with an intention that prices will go down, prices will go up. That is my intention. So I took a long position. Long position is nothing but I purchased the shares in order to keep it for a long time to get a profit. But again, I'm selling the shares because I'm expecting that prices are decreasing in the future. With that intention, with that expectations, I'm selling the shares. So the moment when you're taking a decision to sell the shares, that is called you are switching back to the short position. Basically, you are squaring off the long position. We are squaring off a long position by taking short position. Understanding? Understanding everyone.
Yes.
Yes, sir.
So basically, the purpose is nothing but normally for the day traders, especially for the short-term trading strategies and all, this square off is very, very common. Frequently, like open and close positions within the same trading day, if you want to do, in order to capture the profits from the small price movements, we will do this square off actually. Yesterday we spoke, right? There is a post-trading market period. Normally, the purpose is to square off the positions in the we have a post-trading sessions. Okay, pre-trading, post-trading hours we have discussed, right? So in the post-trading hours, we can square off these positions. Okay, that is about square off and long position. And we have to talk about trade lifecycle management. So what is this trade lifecycle management? Yesterday also we discussed about one example, right? How the funds will move from one broker to another broker, how money will move from one trader to another trader. Let me discuss the same example again so that you will understand. From here, we have a buyer. Okay, let's assume I am the buyer, Mahesh. Okay, and I'm having an account with the Zerodha. Okay, this is a brokerage app, and we have a stock market, stock exchange, which is a trading. The main trading platform where you can purchase and sell the securities using this brokerage app. We have a broker called Zerodha. And another side, there is a person called Ashok. Okay, and again he is using some angel broking. What is angel broking? It is also a broker. So Ashok Broker is angel broking. He's having demat account with angel broking, and Mahesh, me having an account with Zerodha. Okay, Ashok is a seller. If I place an order to buy any securities, I am placing an order to purchase 100 shares of TCS company at market price. This is the instruction I'm giving to the broker. Now, broker what will do? What will do broker? What he will do? He will
Broker,
check. He
He's
will
going
check
to
the
match
availability
that.
of shares at whatever the price I'm asking with the stock exchange. Again, how stock exchange will know whether the securities are available for the buying or not? He will check with the sellers. A lot of sellers also will be there, right? Who can bid their sellers selling trades. So they will check with the sellers. If order is matching, then stock exchange will execute the order. We are just giving an instruction to the broker only. Broker have an account with the stock exchange directly. We do not have an account with the stock exchange. Brokers have an account. In middle of this buyers sellers, we have a brokers, right? Again, so those brokers have an account with the stock exchange. So you are giving instruction to broker to execute the trade. So broker will check the availability of shares in the stock exchange. Then they will execute the trade on behalf of you. Suppose you have a money will be deducted from your account. It will go to the which account?
in Zerodha account.
Zerodha.
Okay.
Zerodha will transfer to the stock exchange, from stock exchange to again angel broking, again from there to seller. Similarly, the shares also will transfer from seller to Mahesh. The entire process will be completing. This is called trade life cycle. If you want to settle any trade, the entire process should get complete. What is that entire process? I should place an order with the broker. Broker will check the availability, the trade availability, and also they have to check some validations will be there, have to be done, right? So validations will be done. Then Ashok, the seller should also have the shares. So that checking also need to be done. Then again, shares should be transferred from seller to Mahesh. All this process is called trade life cycle. Trade life cycle, TLS. So in this trade life cycle, normally we have 3 departments: front office, middle office, and back office. Do you guys heard about it?
Sir? Yes,
You guys heard about the trade life cycle, back office, middle office, front office. Different departments will be there in this trade offices. Trade life cycle. Even before that, you tell me how much time it will take to complete this entire transaction, like to transfer money from one account to another account, and also to receive the shares from seller account to buyer account. How much time it will take?
Seller account and buyer account to shares only, immediately it will be done.
What about the settlement?
Settlement to T+1. T+1.
So T+1. You know what is meant by T+1?
Transaction day plus 1 day. 1 working day.
We call it as a trade life cycle. Every stock exchange will have a trade life cycle. In India, we had earlier T+2. Trade date plus 1 day was taking, or 2 days were taking to settle that trade. But nowadays we have, last year or before that year, they have implemented T+1. So from here, transaction date plus 1 day will be done to settle the trade. The settlement process will take T+1. This is called trade life cycle. Very, very, very important. Trade life cycle management. Because if you are as a fund accountant, as fund administrator, when we are performing the reconciliations, we'll get a lot of questions. When the trade got settled, why it's not reflecting custodian account, why it's not reflecting the broker statement, why it's not reflecting the the client books of accounts. Sometimes cash balance will be related, but still the shares are not reflecting into our account. Broker might not given not transfer the shares from broker account to custodian. There will be a lot of reasons. We call it as the trade breaks, trade review breaks. So that process also will be discussed later in the fund accounting. So for that reason, we need to understand the trade life cycle. Okay. Now you understood, right? How the process will be happening to settle the trade and what is the trade T+1, what is the trade life cycle? Everyone understood?
Yes, Mahesh.
Yes.
Now we will see the departments that have been involved in this trade life cycle. The first one is front
Sir,
office. You know what is the front office? Yeah.
sir, for broker, how much they will get income? So they will get commission, sir.
Yeah, broker commissions also will be there.
Oops.
Brokerage charges will be there. As a fund accountant, we have to post entries related to the broker charges also. Basically, we're talking
Okay,
about the trade life cycle. Life cycle means only the number of days it will take, the period, how much time it will take to transfer the securities, how much time it will take to settle the trade. The settlement process will be there, right, for every transaction. That's we are talking about it as a trade life cycle. So in this trade life cycle, there will be a front end office, and we have a middle office and back office. So where are we going to work? In the front office, middle office, or back office?
Sir,
Where do you guys are expecting to work in the companies once you get a placement? In which phase you will be working? Front office, middle office, or back office?
Middle office or back office, I think. I don't know clearly.
Middle office.
Either you will be in a, most of the candidates will be in a back office. Very rare we have a middle office operations. Even in Morgan Stanley also, we don't have to have a middle office operations for all the
Okay.
securities. Okay, front office, never. We are not going to be part of any front office. Front office is nothing but the persons who execute the trades. Like here, Mahesh is there, right? I'm as a buyer, I'm taking the decision, I'm giving an instruction to the broker, purchase this many shares. Sir, but that way we can also do, right? We are learning all these concepts, how the trading is working, how to purchase shares, how to sell the shares. Then why can't we place in the front office? It's not something like purchasing 100 shares of TCS companies, guys. A lot of crores of money will be there. Will you be able to manage and will you be able to handle those crores of money with the different stock exchanges, not with the Indian stock exchange? Will you be able to manage? No, we are not all going to be in the front office department. In India, most of the companies do not have a front office team. Only have a middle office and back office. Front office is nothing but where the trades will be executed. Capturing and executions will be done in the front office. Basically, the capturing and executions are based on actually. Execution of trades will be done in the front office. Execution is anything but there will be a person who decide how many shares and when to purchase, how many shares need to purchase, how many shares we have to sell, which company shares we have to sell. This kind of decisions will be taken by the front office people. Basically, we call them as a investment manager. Again, in the fund accounting concepts, we'll talk about him. Investment manager. In the IPO, we spoke about participants of IPO, right? Similarly, in the fund accounting also, there will be a number of people will be involved, the participants. So then we will discuss about IM, investment manager. So investment manager who will take the decisions for the execution of the trades, all the investment decisions. If I'm purchasing a trade, I'm see here as a buyer, I'm purchasing the share, right? So as an investor, I'm taking the decision to purchase the securities, right? Right or not? Similarly,
Yes.
as a fund, if I'm holding a fund, from the fund view, from the fund perspective, on behalf of fund, if they want to purchase any securities, that is also an investment, right? So to take this investment decisions, there will be a person called investment manager. They will take the investment decisions. Investment is nothing but purchasing of securities. Investing. We are investing into the securities and stocks. So that will be done in the front office. And we have a middle office operations. In the middle of operations, normally validations, booking, confirmations will be done. Yes, we have a booking work. We may have to book the trades and the funds, and validations will be there. The reconciliations work, that is also middle office operations, and confirmations. This all work will be done in the middle office, and we have a back office. Back office where the clearing and settlement accounting work will be done. Accounting and clearing and settlement. These things will be done in the back office. Now tell me, in the back office or middle office, in the front office, in which phase we may have to interact with the banks, custodians, and clearing firms?
Back office.
In the back
Settlement,
office.
settlement.
The settlement, accounting process, clearing process is there, right? So in the back
Yes.
office only, we may have to interact with the banks and the broker statements and custodians. You know already what is meant by custodians. Already we discussed, right? In layman terms, what is meant by custodians, clearing firms.
Yes, Mahesh.
Clearing firms is nothing but there will be clearing corporations for every stock
Yes.
exchange. So
Yes.
basically, they will settle and they will clear our trades. Again, we'll talk about it later. Okay. So basically, this is all the trade life cycle. You may get a lot of questions about the trade life cycle management. So you all should be good with this concept of trade life cycle. Trade life cycle is basically from the execution to until we settle the trade. The process that we have involved in the trade execution, we call it as a trade life cycle. It depends upon the stock exchange. It will vary from T+1 or T+2, T+3. But in most of the stock exchanges, they're following T+1. Okay. In the front office, trade execution will be done. In the middle office, booking confirmations, validations will be done. In the back office, accounting and clearing settlement will be done. So this is how we should be able to explain if we get any question about the trade life cycle management. Are you guys good with this? Everyone?
Okay.
Then what else? No. Yeah, Mo.
What is difference between the transport layer security and trade layer security?
Sorry, Mo, come again. Transfer?
Transport layer security or the trade layer security?
Not exactly getting.
Transport layer security and trade security.
Transport.
Transport layer security is in networking. It will be there. It will be there in networking.
I'm not getting the point. Transport.
TLS is there. TLS same word is there. If you Google it, it will shows that transport layer security.
Okay, what is it?
This is a networking issue. Once the networking connection will be there, the data transporting, then security layer will be there. That is called TLS.
Is it related to stock exchanges?
No, it is not related to stock
Trade
exchange.
life
It is network. It is not trade like this is for only for networking.
I'm not
System
getting.
network.
Is it
System
something related to the MLM, multi-level marketing? Something?
No. This is not for anything. This is not for TLS. Is not for anything. This is for only system networkings.
System networking.
Software system networking. So suppose LAN network.
You're talking about HTTP, hypertext transfer.
That's she is asking the TLS.
That's a bit different now. That's something related to the HDFC, I think. It's
No,
about the
not.
That's about the protocol securities. Normally, we will build the website site. Even we have a website called Aspect Accession that is not TLS supported, HTTP supported.
Yes. If we Google it, TLS, that's transport layer security. It is showing. That is the reason I think she is asking that question.
That's a bit different concept. We are not talking about it. I hope I have answered your question, ma'am. Is everyone good with these concepts? Everyone. So basically, these are all the information about the stock markets. I mean, the secondary market. And one more thing I need to discuss about the stocks and shares. Already we're talking about stocks, shares, and all, right. You might heard about equity shares, preference shares. Majorly, we will hear about equity shares only. Equity. What do you mean by equity? First, we'll talk about funds. In company, we have two types of funds. Already we discussed in the class 1 itself. What kind of funds we have? Own funds and loan funds, right? Do you remember?
Yes,
What is
Mahesh.
own fund and what is loan fund? If I started my company, I have a 10 lakhs capital, 10 lakhs cash I have. So this 10 lakhs cash is consisting of own fund as well as the loan fund. Now tell me, what do you mean by own fund?
Own fund, sir.
Own fund means?
My own fund.
So savings.
Own savings, sir.
My savings.
Suppose there is a partner as well who contributed some amount. Is that a own fund or loan fund? Partners capital contribution.
That is also one fund.
So won't
That is also one fund.
Okay, if I took a loan from HDFC Bank, is that a own fund or loan fund?
That
Loan
is
fund.
comes
Loan
under
fund,
loan
sir.
funds.
Now you understand the difference between own and loan, right? These are the only two types
Yeah.
of funds. Okay, the own fund we call it as an equity. Okay, the owner's fund. Equity is nothing but owner's fund. Owner's fund means not only the capital contributed by the partners. We spoke about the reserves and the retained earnings. Retained earnings, I think we didn't talk, but we spoke about reserves, right? You guys remember?
Yes, yes, yes.
What is reserves?
Yes, sir.
Suppose if any profit will be there, we'll put some amount as a reserve.
Amount by side for future purpose.
So yeah, every month, maybe every year we make it a profits, right? So we do not distribute all the profits among our partners. We will keep it aside for our future purposes. Maybe if you are getting 1 lakh profit, we will distribute the profit among partners like 40,000, 40,000 as 80,000. Remaining 20,000 will be kept for future purpose. That's we call reserves. Even that reserves is also bonus fund only. Because they earned it. Because of the capital employed, they have earned the profit. The capital, the profit they are keeping for the future purpose. So as a partner, as a shareholder, they have a right in this reserves also. Correct?
Yes,
Now,
Mahesh.
now
Yes,
we are
Mahesh.
going to talk about this own funds. We are talking about equity. But again, in the own funds, we have two types of capital. As a capital, as a shares, we have two types of shares. One is the equity shares. Another one is preference shares. You guys heard anyway? What is the equity share, preference shares? Any commerce students? This is the intermediate
had-
first year question.
I had it, but I forgot.
So basically, equity means the real owners. We call them as the real owners. Suppose if I'm contributing any capital under the equity shareholder. So the equity shareholder intention is until the company is, I do not demand back my capital. As an equity shareholder, I can contribute my capital to the business, but I cannot demand back from the business. If you want to sell your share, you can sell it to someone else, but I don't give it back to you. That is the concept of equity shareholders. It's for the very long-term nature. Equity shareholders will return back the capital from the company only at the time of liquidation of the company. Until the company is going for liquidation, there won't be return back of capital. Suppose if I'm in the TCS company itself, if I'm purchasing one equity share, can I go and ask TCS share like give me money back, I'll give you a share like that? Can I ask TCS company?
No.
If you want, you can sell it in the market. Market is there, right? You can sell it in the market. But for the equity shareholders, money won't be returned. That is the concept of equity shareholders. There is a preference shareholders again. The preference shareholders, these are also these preference shareholders are the owners only. But there is a fixed term.
Match once again.
Yeah.
For equity shares, if company announces share buyback, it is possible, right?
It's buyback. It's possible.
Share.
If company wants to buy back the shares, it's possible.
Okay.
That is the corporate action. In the corporate action, you have a mandatory corporate actions and a voluntary corporate action. Again, the buyback is not a mandatory. It's a voluntary corporate action. If company is buying back from the shareholders with higher than the market price, it's an option. It's not a mandatory again.
Okay.
We'll talk about it in the corporate actions. Again, we'll talk about buyback, right shares, stock split, reverse stock split, dividend, right issue. All these things we'll discuss there. Okay.
Oh, okay.
So, and the equity shareholders, once money contributed, as an equity shareholders, I cannot return back the capital. Only I'll get my capital back at the time of liquidation of the company. Otherwise, if you want to realize in the form of cash, you can sell it in the open market. We have a market rate, stock exchange. Go and sell your share there. You'll get a cash. That is called equity shareholders. And we have a preference shareholders. The preference shareholders are also owners, but there will be time duration. Suppose if I purchase one share, preference shareholders, there will be time duration for that share. Let's say for 20 years. The maximum is 20 years. More than 20 years, we cannot keep it for a preference shareholders. After 20 years, company should collect back their share and they should redeem the share. Redemption is nothing but giving back their money. You know about this word, subscription redemption? You know what is subscribe and redeem? You know about these words?
Activating this service subscription.
Normally, if I'm purchasing Amazon thing, what do you mean by subscribing Amazon Prime? What is the meaning of subscribe?
Use and pay and use, something like that.
Basically, we are using the service. We are acquiring the service, right? Similarly, subscribe is nothing but we are purchasing the share. Redemption means and redeeming means we are selling the share. Okay. So there is obligation from the company side. Preference shareholders should be redeemable. Always it's a redeemable after 20 years. Maximum is 20 years. Even before that itself, company can redeem the shares as per the share policy they have given. As per the policy, they can redeem their share. Redemption is nothing but they will collect their share back from the shareholders and they will provide their capital to the shareholders. That is called preference shares. Now we will talk about the features of this equity shares and preference shares. Now tell me which one is best? Equity share is best or preference share is best? We discussed about the features, right? Normal one feature only we discussed. What is that feature? Preference shareholders is a mandatory redeemable. After specific duration, the capital will be returned to the investor. And equity shareholders, I do not have a choice. I have to stay back with the company only. If you want to get your capital, cash, you can sell it in the market. So which one is best?
Preference shares is best.
Maybe it's very difficult to determine which one is good with this single feature. Let me talk about.
Your voice is not clear. It's dropping. Can you check once, please?
Is it the same thing for everyone?
No.
No. Yes, sir.
Maybe from the bandwidth issue, I think from your end. Please check that one. There is a person who joined with a Vivo. Can you please join with your name? I'm not actually checking all your person names. Surprisingly finding another candidate seems. If you are not joining with your name, then I'll remove you from the team. Okay. So let's talk more features about the equity shares and preference shares. So you know the beauty of equity shares. Suppose I'm running a company. Okay. This example will be a bit interesting. I'm running ABC company, ABC Limited. Okay. And let's talk about these are the owners, right? Equity shares, preference shares, both are owners only. Okay. And there is a one more person called loan. We got some loan from HDFC. Okay, let's assume, keep it aside, and let's assume we got a loan from bank as well. Okay. ABC company in the first year, they got a profit of 100 rupees, 1,000 rupees. Who will distribute this profit? Equity shareholders will get, or preference shareholders will get?
Equity shareholders.
The entire profit will be distributed to the equity shareholders.
Yes.
What about the preference shareholders then?
That is the time period is there.
Though it's a time period, then why should I invest into the market without holding, without expecting profit? There should be some expectations, there should be return. After 10 years, 20 years, maybe the capital will be redeemed. I'll get my cash. But what about returns until that period? So there will be dividend, there will be profit distribution to both the shareholders. Equity shareholders will also have a right, and preference shareholders also have a right to participate in the profits. But what extent, sir? How they will distribute the profits between equity shareholders and preference shareholders? As the preference shareholders, they have a fixed fixed determination. As per the predetermination, fixed percentage. We can say fixed percentage of profits will be there. Fixed percentage of dividends will be there for the preference shareholders. Let's assume they have determined that preference shareholders will get a 10% of dividend, 10% of the shares face value. That is the determination they have given in the share certificate. While purchasing the preference shares, there will be written in the, there will be written format. We are going to provide 10% of face value, 10% of share value. We are going to give you the dividend on a yearly basis. Like that, there will be a condition. So whatever the percentage they have mentioned in the certificate, that percentage of return will be given to the preference shareholders. Okay, it's a fixed percentage of dividend. But equity shareholders, there is no fixed percentage of dividend. They can enjoy unlimited profit. They can enjoy unlimited profit. How they will distribute, sir? Now we have like let's assume I'm converting this 10 rupees to 100 rupees. Okay, just for our understanding purpose, let's assume the 10% of our fixed preference shares value is 100 rupees. Now, preference shares profit is 100 rupees. Who will distribute first? Preference shares will participate or equity shares participate? It is 1000 rupees.
First preference shareholders.
So first preference shares will come and participate in the distribution of a dividend. Again, understand the preference shareholders always have a right in participation of dividends for the first time. Even before distributing profit to the equity shareholders, preference shareholders always have a right to participate in the dividend. So the first preference will be given to the whom? Preference
shareholders.
Use preference shareholders dividend. How much?
100 rupees.
100. So what will be the profit available for the equity shareholders?
900.
900.
So we can say, right, profit available for equity shareholders. How much?
Yes.
900.
900.
900, right?
Yes.
Yes.
Yeah, this is correct. Among the partners, first preference shares will come and participate, and equity shares are distributing 900 rupees. That's fine. What about this loan people? We have to pay interest, right?
Yes.
So when they will pay,
After-
when we will pay interest?
After
distributing
that,
profit, we will pay now.
No.
If it profit or loss, we have to pay the loan. Loan
So
is different
it is a
for
profit,
that
right?
profit.
So when we should pay?
That is completely different because loan is loan we have to pay their interest. If it is loss or profit, we
So
have to pay the
whenever
loan.
there is a debt, whenever there is a debt, we have to pay interest, right? Let's assume
Yes.
there is an interest of that 3%. Again, it is coming around. Let's assume 60
300.
rupees. Let's assume 60
okay.
rupees. Okay.
60
Okay.
rupees.
Now, first we have to pay. The moment you receive the profit, we have to pay the expenses. It's an expense, right? So we have to pay the
Yes.
interest. So we have to pay the interest. So let's pay the interest. Sorry. Interest. How much?
60 rupees.
60.
rupees. And what is the profit available for the shareholders? There is the profit available for shareholders, total shareholders. How much?
940.
940.
940. Out of this 940, how much preference shares will participate?
10%.
94. 94.
No, I said 100 rupees is a fixed.
No. Why? Because 1000 rupees is the
10%, see
profit.
guys, this
Yes.
10% is not on profits. The 10% is preference shareholders capital. That's why we have given assumption that 10% on this preference shares, let's assume it as 100. Every year they will receive 100. It's a fixed.
Yes.
It's not going to
Yes.
change.
Okay.
So preference shareholders will come and participate 100 rupees profit. What is the amount available for the equity shareholders after giving this 100 rupees to the preference shareholders?
840.
No.
840.
840 rupees will be available for the equity shareholders. This is case 1. This is case 1. Or let's assume it's for the first year or something. Okay. Let's come to the case 2. Okay. Or else I'll say year 2. We'll keep it as a year 2. This is a year 1. Okay. Again, the year 2, ABC Limited performed 2000 rupees profit. Profit doubled for the second year. Now tell me how much interest we will pay?
120.
Interest 60 rupees.
Interest
60
is always
rupees.
fixed. Suppose we are getting a
In
more
interest,
profits, will you pay extra interest?
No.
No, right?
No.
Interest is
Same
fixed
interest
only.
will be coming.
So after providing this interest, how much profit will be available for the shareholders?
1940.
1940.
1940. Okay. How much profit will be given to the preference shareholders?
100.
100 rupees, sir.
Same.
Can I give more preference dividend because I'm getting more profits,
No.
right?
No,
Yes,
sir.
sir.
It is a
Always
fixed
fixed.
dividend.
It is always a fixed percentage of return.
So
So
Yes,
they
sir.
will get 100 rupees. So how much will be available for the equity shareholders?
1840.
1840.
1840. This is the year 2. So now who is most benefitable in this case? Who is getting more benefit?
Equity
Equity
shareholders.
share. Equity shareholder.
Equity
To
shareholders.
understand one thing, equity shareholders will always have a unlimited profit. Unlimited profit. Whatever the profit available after distributing to the interest, after distributing preference shareholders, whatever the amount left available, that you can enjoy. Let's assume in the third year, year 3. Okay. There is a loss of 1500. Now how much you will pay?
60.
60 rupees will be interest.
60 rupees interest.
Interest is the
rupees.
same.
So what is the
1560.
profit available for the equity shareholders?
Loss is 1560.
1560 is
1560.
available for the shareholders. How much preference shareholders will get?
100 rupees.
100 rupees.
100 rupees.
0.
Zero or 100?
Sorry. No.
10%.
If it is no, this year will not give. Next year, if profits will be there, 2 years will give one time. I
See,
think.
again, here the point is in the preference shareholders also we have two types. One is redeemable preference shares.
Non-redeemable preference shares.
Sorry, participative, non-participative, not redeemable. Non-redeemable means they'll convert it into debentures or they'll convert it into equities. Okay.
Cumulative, I think. Yes.
Yeah, cumulative.
non-
Cumulative is the correct word. Cumulative preference shareholders and non-cumulative. You know what is the meaning of cumulative? In statistics, there is a frequency, cumulative frequency. Do you guys understood what is the cumulative frequency? Suppose there will be like this: 1, 2, 3, 4, 5, 6. This is a frequency. Okay. And there is a sigma f, that means cumulative frequency. How you will calculate cumulative frequency? It's a 1, it's a 3,
3,
it's a 3
5,
plus 3, 6.
6,
3 plus 3, 6, right?
10,
6 plus 4, 10.
10,
10 plus 5,
15.
15. 15 plus 6, 21. This is called cumulative frequency. What we are doing for every year, for every frequency, we're adding with the previous frequency, right?
Yes, sir.
Then it's going like this. This is called cumulative frequency. The same concept will be applied for the cumulative preference shareholders also. We have two types of preference shareholders: cumulative, non-cumulative. So first we'll talk about non-cumulative. We'll talk about non-cumulative preference shareholders. So in the non-cumulative, then they don't have a right to accumulate their profit. Accumulate means there is no point of adding profits. If there is a profit, I'll give you the profit. I'll distribute profit. If there is no loss, I don't give you. If I have a profit, I'll give you. If I do not have a profit, I don't give you. Again, you should not ask me next year. There will be profits next year, but again, next year you cannot ask me for the previous year profit. Whatever the year, I mean, and whichever the year I will get a profit, that year only you will get a profit. If there is a loss, you don't get anything. Again, next year, if I get a profit, then I'll give you that year profit. That is called non-cumulative. In this case, now tell me, let's assume we are talking about non-cumulative. Okay, let's talk about non-cumulative preference shares. Now tell me how much preference shareholders will get a dividend?
0.
0. There is a loss, so we are not giving anything because you are non-cumulative preference shareholders. So I'm not giving anything. So how much loss will be available for the equity shareholders?
1560.
60.
So they can enjoy this loss also. Now tell me who is benefitable?
Preference shareholders. In this case,
We will see one more scenario. Okay, in the year 4. Okay, in the year 4. In the year 4, there is again profit of 4,000. Now tell me how much interest we have to pay?
60.
60.
60. How much profit will be available after paying this interest?
3940. 3940.
1940.
Okay, how much profit we have to pay to the preference shareholders? This time, let's assume we have a cumulative preference shareholders. Cumulative preference shareholders.
200.
This year profit 100 rupees I have to pay now.
Yes.
Yes, sir.
This year profit 100 rupees. Plus
Yes.
previous year profit also I
Loss.
had to pay, right? Previous year I had a loss, that's why I didn't pay anything. Now we have a profit. So I have a right to claim back my previous year profit also. That is the power of cumulative preference shareholders. So I'll get a cumulative of 100 rupees of previous year. Both together, I'll get 200 rupees. After paying this 200 rupees, how much profit will be available for the equity shareholders?
3740.
3740. This is the power of cumulative preference shareholders. Now we understood the difference between equity and preference and cumulative and non-cumulative.
Yes, Mahesh.
Yes.
Everyone?
Yes, Mahesh.
Is this difficult? to understand, to remember or something?
No.
Quite easy, right?
Yes.
Yes.
Yes, sir.
And normally as the equity shareholders, we have a voting rights. If you are equity shareholders, they always have voting rights. In the board meetings, annual general meetings, you can go and use your voting. But as the preference shareholders, you do not have any voting rights. Do not have any voting rights. But we have this cumulative, right? Cumulative preference shareholders. If the cumulative period is more than certain period, as per the Companies Act, there is a certain duration. 5 years or 10 years or something, there is a duration. So for those many years, if they're not receiving dividend, if they're cumulative shareholders, they will also get a voting right. That is the additional feature they have in the cumulative preference shareholders, but it's not required for our IB concepts and fund accounting concepts. We are not going to deal with the regulatory thing or something, but just for understanding purpose, we need to differentiate between equity shareholders and the preference shareholders. Again, in the preference shareholders, we have a concept called cumulative and non-cumulative. Now, I hope you're all good with this concept.
Yes, Mahesh.
Yes,
I'll
ma'am.
give you one more input about preference shareholders concept. Suppose they're liquidating the company. They're liquidating the company. They're closing the company. So they're selling the company. So they have liabilities like this. They have a loan. Let's assume they have equity share capital. They have a 10,000 and a preference share capital. They have a 5,000 and they have a loan as well. Loan amount, let's say 7,000 they have. Okay, this is the balance sheet items. I mean the capital, their loan and all. I'm not talking about assets. But so let's assume I'm selling my entire assets, company assets. I'm selling my entire company assets for 40,000. For how much I'm selling the entire assets of assets? 40,000.
40,000.
So to whom I have to pay first?
First loan.
First I have to pay loan.
Loan.
How much I have to pay?
Loan amount.
7,000.
7,000.
7,000
Then
plus
to
interest.
whom I have to pay? Yeah, whatever we are considering interest already paid for every year. Now we are liquidating, we have to
Okay.
pay up the principal amount. That's an assumption, okay?
Next,
So
preference shareholders.
Share
yeah,
capital.
so first we have to pay to the preference share capital.
Preference.
We have to pay. And
Then
equity
whatever the
shareholders
amount will be
come and
there.
participate. Whatever the amount available after paying all this loan and preference
Equity
shares,
share.
they will come and participate. Okay, let's assume we could sold those assets only for 10,000. Only for 10,000. Now, how much we have to pay for loan?
Loan compulsory. Loan compulsory.
Loan is 7,000 we
7,000.
have to pay. And what about the preference share capital?
Even preference share also, if we have a rights, whatever the agreement will be there, if it is a loss, this much percentage will be given like that. We have to pay like that, or else we'll pay complete amount.
So preference shareholders will also get 5,000 rupees. But this 5,000 rupees should be paid from the equity shareholders pocket again. Otherwise, in some cases, whatever the amount left after paying 7,000, we have only 3,000. 3,000 will be given to the preference share capital, and equity shareholders will get 0. This is called liquidation concept. Okay. So even in the liquidation also, always preference shareholders will have a right to participate even before giving capital. I mean capital or maybe profit to the equity shareholders. That's because the preference. They always have a preference in the dividends. They always have a preference in participating at the time of liquidation also. But they have a fixed rate of dividend. Now we understood the share capital types. Everyone?
Yes.
Yes.
Is
Yes,
everyone good
Mahesh.
with these concepts? Everyone?
Yes, sir.
Mahesh.
Very good. Can everyone turn on your cameras now? I'll stop recording.